The four most dangerous words in investing are "this time it's different." The market is currently acting like that friend who chugs a Four Loko at 3 a.m. and cries about their ex, then tries to do calculus. 1 minute, recession. Next minute, the moon. Gold is up, bonds are down. Bitcoin is having an identity crisis, and the AI bubble is deflating faster than my New Year's resolution. You are not crazy for being confused. You are sane in an insane environment. Today, we are going to time travel. We are going back to 1972. Because what is happening right now, it's not a crash, it's a sequel. And you need to know how the movie ends before the third act. Flashback to 1972. The economy was a mess. Inflation was hot, gas lines were forming, the stock market was unstoppable. There was a group of stocks called the Nifty 50. Think Polaroid, Xerox, McDonald's. The logic was simple. These companies were the future. They are quality. You can pay any quality price then. Sound familiar? It's 2023 and 2024 with the Magnificent Seven. Back then, investors pushed PE ratios to 70x, 80x, 90x. They said valuations don't matter anymore. Then, the bottom fell out. From 1973 to 1974, the Nifty 50 got slaughtered. They didn't go down 10%. They went down to 50%, 60%, and even 70%. McDonald's fell at 62%. It took them 2 decades to recover. Why? Because the Fed raised rates to kill inflation. And suddenly, paying any price became a suicide pact. So, back to 2024. Look at the numbers. The S&P 500 is trading at 22 times forward earnings. That's not cheap. That's the top 15% of historical valuations. But the Magnificent Seven? They are at 32x. And one specific stock, let's call it the AI emperor with no clothes on, is sitting at 70x. Here is the twist. The villain isn't the Fed. The villain is complacency. The CBOE Volatility Index is lower today than it was in 2007, right before the housing market exploded. Central banks globally bought over 1,000 tons of gold last year. Why? Because they smell the smoke. But retail traders, they are buying zero DTE options like lottery tickets. 36% of all options volume right now is expiring today. Translation, we are betting the rent money on a coin flip. Here is what nobody on CNBC will tell you. The economy is bifurcated. That's a fancy word for schizophrenic. The top 10% of earners control 70% of the wealth. They are spending like crazy on travel and luxury goods. That keeps the GDP number looking sexy. Meanwhile, credit card debt just hit $1.1 trillion. Delinquency rates are rising among Gen Z and millennials. So what happens when the AI hype hits a wall? If the Magnificent Seven, which now account for 30% of the S&P 500's total weight, roll over, there is no rotation to save you. It's not 2000. It's worse. Because in 2000, the rest of the market was cheap. Today, everything is expensive. Bonds are risky. Real estate is frozen. Cash yields 5%, but inflation is sticky at 3.5%. You are trying to fight a fire with a squirt gun. Look, I'm not here to tell you to sell everything and buy a bunker in Montana. History doesn't repeat, but it rhymes. The 1970s taught us that you can have a terrible economy and a flat stock market for a decade. Or you can have a booming GDP and a crashing market. The two are not connected anymore. The single best move right now? Risk management. Don't ask, is the market going up or down? Ask, what happens to my portfolio if I'm wrong? Hold some cash. Own a little gold if it helps you sleep. And for the love of Warren Buffett, stop checking your phone every 5 minutes. The market's job is to transfer wealth from the impatient to the patient. You are not late. You are not early.
you are right on time to do absolutely nothing stupid. Stay solvent, stay curious, and whatever you do, don't trust the Four Loko. This is not financial advice. I'm just a storyteller. See you in the next one.